Hey guys, what's going on? It's Calvin Stewart, broker owner of Stewart Real Estate. Happy 2018. Hope you guys are having an awesome year so far. I hope you guys have a lot of great plans for 2018. I hope all of those plans come true. So, today I wanted to just post a quick video about something I come across a lot, something that's close to my heart. A lot of people ask me about. I wanted to make sure I conveyed it to you guys so you guys understand it. Before I get in, make sure you subscribe, make sure you like, make sure you share this video. I am definitely trying to build up my YouTube channel in 2018. It's one of my goals. And let's get right into it. So one of the major reasons, if not the major reason for not being able to purchase a house, this one is your debt to income ratio. That debt to income ratio, I don't know if you guys have heard that before, but pretty much how much do you owe versus how much do you make. That ratio, that number, is going to be a huge factor in the qualification process of what you can buy. I definitely think everybody should strive to be debt free, but we do know that that's not always the case, at least in the beginning. A lot of people have to work to get out of debt. So, what does debt to income ratio have to do with you purchasing a house? When your lender's going to go ahead and pre-qualify you for a property, they're going to check to see how many people do you owe, how much money are you making, are you able to pay a certain amount of money on this property comfortably and consistently. When you guys are renting an apartment or renting a townhouse, they might not be as stringent on that as when you're going to go ahead and purchase your property. And of course, everybody knows renting your money, you're just throwing money away to the landlord. You definitely want to own your own property. You definitely want to start putting money into your own pocket, eventually pay off that mortgage so that you are living for free and all of your money can just go to you having fun, to your retirement, and to your investments. So let's get into it. Let's just say you made about $2,000 a month. Let's just use that as a number. So that's $24,000 a year. The way the lenders look at your debt to income ratio is they're going to take about 40 to 50% of that. That number is how much you can spend yearly, how much you can spend monthly on a mortgage. What factors into that number is all of your debts, like any of your credit cards that you may have, any of the student loans you may have, any car note you may have, any creditors that are constantly, coming after their money. Those debts are going to be what's factored into that 50 or 40% debt to income ratio where they're looking at. So with a debt to income ratio on an income of $2,000 a month, which is $24,000 a year, which is pretty much minimum wage, we're looking at, let's just say you had no debts, you could spend about $1,000 a month at a 50% back end, 50% debt to income ratio. You can spend about $1,000 a month. So in $1,000 a month, you can theoretically be buying $120,000 property, $130,000 property with $1,000 a month. That is, of course, going to include your property taxes and your condo fees, depending on how much those are going to depend on your house size. But you can buy that much property. And a lot of times people are paying rent for $1,400, $1,500, $1,600 a month, where they can be pretty much buying the same exact thing for a lot less money. So if you have a car note, they're going to subtract that car note from that $1,000 back end that you have to pay. So they're going to take away your car note. They're going to take away all your minimum monthly payments on your credit cards. This is why it is so important to not have any payments. Try to, reduce the amount of credit cards that you have. If you're going to be purchasing a car, don't max out. Don't buy something extravagant if you don't have the finances for it right away. It's always better to go ahead and buy something used, buy something cheaper for a couple months, maybe a couple years, save up some more money and put some more money down on the car to bring those payments down lower. Or maybe pay for the pay for the car in cash, especially if it's like a $5,000, $6,000, $7,000, $8,000 car, which is very doable. You can go buy a Honda Accord. It's a couple grand. Either save enough cash to go get that, or make sure you're not buying the brand new one that's going to cost you $30,000, $40,000, $50,000, and it's going to run you $700, $800 a month. So definitely watch your monthly expenses. You want to make sure that debt to income ratio stays really, really low, and you want to be able to live well below your means. Even when the lender goes ahead and gives you a pre-qualification amount, a number that you can hit, my suggestion personally is don't max that number out. Let's say use that $24,000 a year example, which I just did before, and you have no debt, the lender's going to say, okay, you can, have a payment qualifying you up to $1,000 a month. You already know that's half of your income. Unless you're saving another 30% of your income, I do not suggest maxing that out. Go ahead and get something that's a payment of $700 a month. Get something that's a payment of $600 a month. Buy in the low end of your scale. Increase your income, save up your money, pay more money towards your loan, and eventually you're going to live your whole entire life debt free, including your mortgage. But that's one of the major things that I see on a day-to-day basis is a lot of people make really, really, really good income. They have, a great credit score because they're paying all of their bills on time, but their debt to income ratio is pretty high. And a lot of your credit cards, what also has an effect debt to income ratio is your credit card payments. Don't max out your credit cards. When you keep your credit card payments lower than about 33-40% of what the actual value is, you have a credit card that you can run up $1,000 on, and you keep your bill at $300 or less, the creditors look at that more favorably. They understand that you're handling your money correctly, and they're going to want to lend to you better terms, better rates, and your score is going to go up. But when you start maxing out those credit cards, let's say you have credit cards $1,000 and you have on there you have $1,000 limit and you ran up $900. They're looking at it like, okay, this person's pretty much living paycheck to paycheck. They really need this money, so let's go ahead and have this person classified as more of a high risk, because if they miss a paycheck, if they happen to get laid off, they probably won't have enough money to cover it because they pretty much maxed out their limit. So make sure that you are living well below your means. Make sure that a lot of your debts are paid off. Try to have no debt if possible. I know a lot of people, especially the people who are millennials in my bracket, we have a lot of student loan debt. A student loan debt I see is one of the major killers or hurdles that you have to hop over when you're actually getting a loan. Because with student loan debt, a lot of people have deferred payments. If your payment's deferred, they're going to take 1% of that balance. So let's just say, you went ahead and got a bachelor's degree. You financed the whole thing. Let's say you did $20,000, $30,000 a year for college. That's $120,000 just for a bachelor's degree. They're taking 1% of that, and they're using that as a placeholder for your monthly payment if they're deferred. So when you get out of college, depending on the job that you get, it's going to depend on what your actual payment's going to be, because a lot of times people do income, based repayment plans. But you definitely want to get that payment. Make sure you knock out your student loans as quick as possible. Get those down as much as you can. If you're still in college, make sure you get enough grants for those courses that you're taking. Make sure that you get as much scholarships as you can for those courses that you're taking. Make sure you work as many hours and you actually pay those down, because student loan debt is one of the major loan crushers that I see. Student loans and then car payments, because a lot of people like driving a brand new, fancy, expensive car, which it's really good. But if you get a brand new car, make sure you can afford it. Make sure that doesn't skew up your debt to income ratios. Make sure you're not buying something that's well above your means. You should definitely live below your means. Not saying that you shouldn't do that, because if you want to do it, go do it. You work for your money. Make sure that you enjoy it the way you should. But if you're looking to become a homeowner, you're currently renting right now, and you're giving all of your money away to your landlord, there are a couple things that you should sacrifice, and that is, having the most expensive everything, at least temporarily. Once you get yourself underway, you get your property under your belt, you can go ahead and buy whatever you want. So make sure that your spending habits are adequate, you're living well below your means, and you knock out as much debt as possible, because your debt to income ratio is one of the main things that says how much of a house you can actually purchase. So if you have any more questions, make sure you reach out to me, 240-472-7453. I'm not a lender. I'm just a real estate agent. I help people purchase properties. So if you have more direct questions specific to the loan side of it, if you reach out to me, I can definitely give you a lender referral who will be more than happy to answer all of your questions and help you out so that you can know exactly where you need to go next in your specific circumstance. Everybody's circumstance is different, but contrary to a popular belief, and is a lot of people do not have to put that much money down on the property. So instead of saving up all those thousands of dollars which you're saving, of course that's great. Make sure your debt's under control. Make sure you pay that down. Your debt to income ratio is really, really low if possible. That also helps boost your credit score. When you have great credit score, you get the most favorable terms. Once you do that, coming up with the down payment money is a lot simpler than you may think. Houses that you can get a USDA loan, you have to put 0% down. So now you have to pay your closing costs. And, closing costs are negotiable. When you go through different programs, for example, this MPDU program, which I'm very familiar with, it allows you to purchase a property that's moderately priced. So every new build community that you're seeing right now, you're seeing a lot of these houses go up very expensive. In Montgomery County, each new builder is required to reserve 12% of those for their moderately priced dwelling unit program. That program allows you to be able to purchase that fraction of the cost, be able to live there paying dirt cheap, if not half to a third of what you'd be paying without that program. So there are many ways to actually get you into a property. So your main focus right now should be balancing your finances. In 2018, pay down as much debt as you can, because by the end of 2018, you should definitely be purchasing your own property. Once again, if any questions, give me a call, 240-472-7453. You can reach out to me, shoot me an email, calvin@gmail.com. Make sure you subscribe, like, share this video, and ask me any questions you want. I'll talk to you guys soon, okay?